Well, we were pretty convinced that the mortgage market, segments of the mortgage market were overvalued and were likely to implode. So we took a very concentrated position in these securities, and what we expected to happen happened.
Want to unlock the secrets to profiting from the stock market? Master the art of timing with our breakdown of market cycles: expansion, peak, contraction, and trough. Learn how the pros like Warren Buffett and Elon Musk capitalize on these phases, and discover strategies to maximize your returns. Don't miss out. Your next big investment move could be just around the corner. Market cycles. The stock market, much like nature, follows cycles that repeat over time. These cycles consist of 4 phases: expansion, peak, contraction, and trough. Investors often find it challenging to decode these cycles, but understanding them is key to success. In 2008, the market experienced a significant contraction, also known as the Great Recession. During this time, stock prices plummeted and many investors lost hope. However, this was followed by a recovery, entering the expansion phase around 2010, when stock prices steadily increased. Celebrities like Warren Buffett and Elon Musk have made their fortunes by recognizing these cycles early. Understanding when to buy and when to sell can be the difference between losing and winning in the stock market. Mastering market cycles is not just about prediction, it's about timing and strategy. Recognizing market phases can provide investors with a clearer path to profitable decisions. Market phases. The stock market moves through distinct phases, each marked by different economic conditions. These phases include expansion, peak, contraction, and trough. Each one offers unique opportunities for investors, but timing is crucial. During an expansion, the economy grows and stock prices rise. For example, between 2010 and 2020, the market was in an expansion phase, with companies like Apple and Amazon seeing tremendous growth. As stock prices climb, investor confidence grows. However, the market eventually hits a peak, where growth slows and prices stabilize. From here, the market may enter a contraction, like the one seen in 2020 during the pandemic, causing prices to drop dramatically. Finally, the market reaches the trough, the lowest point, before starting the cycle again with another expansion. Recognizing these phases is essential for making informed investment decisions and maximizing profits. Cycle indicators. Identifying market cycle indicators is vital for any investor seeking to understand the stock market. These indicators help signal which phase of the cycle the market is in, providing clues for better investment strategies. Some of the most common indicators include interest rates, inflation data, and stock price trends. For example, when the Federal Reserve lowers interest rates, it often signals the start of an expansion phase. On the other hand, rising inflation could indicate that the market is approaching a peak. Investor sentiment also plays a key role in recognizing these cycles. Celebrities like Ray Dalio have often emphasized the importance of understanding these signals. By analyzing market trends and indicators, investors can better predict the cycle's next move, making smarter decisions to maximize their returns during each phase. Investor psychology. Investor psychology plays a vital role in market cycles. Emotions like fear and greed often drive stock market decisions. During an expansion, investors become overly optimistic, leading to increased buying. This can push stock prices to unsustainable levels. On the flip side, during a contraction, fear takes over, causing panic selling and market crashes. A notable example was the 2008 financial crisis, when fear caused widespread panic, resulting in significant losses. Some famous investors, like Warren Buffett, have mastered their emotions and used market psychology to their advantage. By staying calm during downturns and capitalizing on market dips, they've achieved long-term success. Understanding how psychology impacts market cycles can help investors make more rational and profitable decisions. Macroeconomics. Macroeconomic factors greatly influence market cycles. These include interest rates, inflation, and unemployment rates, which can either fuel or slow down market growth. For example, when the Federal Reserve raises interest rates, borrowing costs increase, often leading to a contraction phase as businesses struggle with higher expenses. In contrast, low interest rates can spark an expansion, encouraging borrowing and investment. The COVID-19 pandemic in 2020 saw massive government spending to boost the economy, which resulted in a brief but intense market recovery. Famous investors like George Soros closely monitor these macroeconomic indicators to predict shifts in market cycles. Understanding these factors helps investors anticipate changes in the market and adjust their strategies to profit from the upcoming phases. Market strategies. Successfully navigating market cycles requires strategic planning. Investors need to adjust their approach depending on whether the market is in expansion, peak, contraction, or trough. During expansion, buying stocks with strong growth potential is key, while at peak, investors may consider selling or rebalancing portfolios to secure profits. In a contraction, investors might look to defensive stocks, which tend to perform better during downturns or even explore short-selling opportunities. As the market enters a trough, savvy investors see the low prices as an opportunity to buy undervalued stocks. Famous investors like Carl Icahn have perfected these strategies over decades. They know when to be aggressive in their approach and when to be cautious, capitalizing on the market's natural cycles for long-term success. Having a well-defined strategy for each phase of the market cycle is crucial for consistent profitability. Case studies. Examining past market cycles provides valuable lessons for investors. One famous case is the 2008 financial crisis, which marked a significant contraction. Stock prices fell dramatically, but those who bought during the trough saw huge returns in the years that followed as the market recovered during the expansion phase. Another notable case is the dot-com bubble of 2000, where stocks in technology companies skyrocketed, only to crash later. Investors who identified the peak and sold off their tech stocks avoided major losses. Celebrities like Jeff Bezos took advantage of these cycles, capitalizing on low prices during downturns to build long-term wealth. By studying these case studies, investors can learn how to identify key moments in the market cycle and make smarter decisions to maximize profits. Risk management. Risk management is crucial when navigating market cycles. Understanding when to take risks and when to protect your investments can make all the difference. During an expansion, it might be tempting to invest aggressively, but it's essential to evaluate each opportunity carefully to avoid overexposure. In times of contraction, risk management becomes even more important. Investors should focus on diversifying their portfolios and holding assets that are less vulnerable to market downturns. Hedging strategies, like buying options or investing in defensive sectors, can help minimize losses. Famous investors like John Paulson made massive profits during the 2008 financial crisis by shorting the housing market, demonstrating the importance of managing risk while positioning for profit. Effective risk management during each phase of the market cycle helps investors protect their portfolios while taking advantage of market opportunities. Timing investments. Timing is everything when it comes to profiting from market cycles. Investors who understand when to enter and exit the market during different phases, expansion, peak, contraction, and trough, can significantly increase their returns. During an expansion, timing involves identifying stocks that are poised for growth. At peak, knowing when to pull back and secure profits is key to avoiding a potential crash. In a contraction, buying during the trough is often the best strategy, as stock prices are at their lowest. Warren Buffett, famously known for his long-term strategy, emphasizes buying when others are fearful. He bought stocks during the market crash of 2008 and made substantial profits as the market recovered. Proper timing and recognizing the phases of the market cycle are crucial for maximizing investment gains. You've learned the power of market cycles. Now it's time to dive deeper. Don't miss our next video, Investing in Sustainability: How ESG Trends Are Shaping Wealth. Hit that subscribe button so you don't miss out on crucial tips that could change your financial future forever.